In 1961, a man named Edward Thorp walked into a Las Vegas casino with a notebook and walked out richer than when he came in. Not because he was lucky, but because he had discovered something the casino had not noticed. A mathematical flaw, a tiny gap between how the game was designed and how it actually behaved. He exploited it legally, repeatedly, and the casino could not stop him. What Thorp found was not illegal. It was not even particularly hidden. It was just a pattern that nobody had looked for yet. That is the central question of this video. How do legal financial exploits actually work? Not fraud, not theft, not insider trading, something stranger. Something the system itself allows and sometimes even encourages until enough people notice and the gap quietly closes. The answer will change how you see every market, every institution, and every rule that governs money. Start with the most basic version of the exploit. Every financial system is built on rules. Rules are written by humans. Humans cannot predict every possible combination of events. So every sufficiently complex system develops gaps, places where the rules technically permit something the designers never intended. These gaps are not mistakes exactly. They are blind spots. And blind spots in finance are worth billions. The first person to find a blind spot profits enormously. The second person profits slightly less. By the time everyone knows about it, the profit disappears and the rule gets rewritten. This cycle has repeated itself throughout the entire history of modern finance. But one exploit ran longer, paid out larger, and affected more ordinary people than almost any other in history. It was called index arbitrage, and almost nobody knows it existed. To understand it, you need to understand what an index is. An index is just a list. The S&P 500 is a list of 500 large American companies. The index tracks the combined value of those companies. When people say the stock market went up today, they usually mean the index went up. The index is not a thing you can buy directly. It is a measurement, a number. But in 1982, a new financial product was created that let you bet on that number. It was called a futures contract, specifically a stock index future. You could agree today to buy or sell the index at a specific price on a specific future date. This sounds simple. The gap it created was anything but. Here is what nobody anticipated. The futures contract and the actual stocks in the index were two separate markets. They traded in different places. They had different buyers and sellers. And crucially, they sometimes moved at different speeds. When news hit the market, the futures contract would reprice almost instantly. The actual stocks would take minutes longer, minutes in which the future showed one price and reality showed another. This gap was tiny, usually a fraction of a percent. But for someone with fast enough computers and large enough trades, a fraction of a percent applied to hundreds of millions of dollars, hundreds of times per day, added up to something staggering. The exploit was straightforward. When futures rose above the stocks, you bought the stocks and sold the futures simultaneously. When they fell below, you reversed it. You were not predicting anything. You were not taking a view on the market. You were simply capturing the mathematical difference between two prices that had to eventually converge. The profit was nearly guaranteed. The firms that built the technology to do this first made extraordinary returns. Goldman Sachs, Morgan Stanley, a handful of specialized trading firms whose names most people have never heard. They hired physicists and mathematicians and built systems that could execute trades in milliseconds. They were not investing in the traditional sense. They were mining a structural gap in the architecture of the market itself. This was completely legal. The SEC had no rule against it. The exchanges permitted it. Nobody had written a law about it because nobody had imagined it would exist. But that was not the strange part. The strange part was what happened on October 19th, 1987. That day is known as Black Monday. The Dow Jones Industrial Average fell 22.6% in a single day, the largest single-day percentage drop in stock market history, larger than any day during the Great Depression. $500 billion in value evaporated before the closing bell. For years, the official explanation was investor panic. People got scared and sold. A cascade of selling fed on itself. The market crashed, but a later investigation by a commission led by Nicholas Brady told a different story. The index arbitrage programs had amplified the crash. When stocks began falling, the futures market fell faster, creating a gap. The arbitrage systems automatically sold stocks to capture the gap. This selling pushed stocks lower, which pushed futures lower, which created a new gap, which triggered more automatic selling. The programs were feeding the crash they were profiting from, a loop with no off switch. The exploit that had silently printed money for 5 years had, on one specific day, helped accelerate one one of the worst financial disasters in modern history. And it was still legal. This is the pattern. Understand it, because it repeats. Every major financial exploit follows the same three phases. Discovery, where one group finds the gap and quietly profits. Expansion, where others notice and pile in, making the gap smaller and requiring more leverage to maintain returns. And then crisis, where the gap closes violently, usually because the system has become dependent on the exploit continuing. The index arbitrage story is a clean version of this pattern. The truly large version is harder to see because it is hiding in plain sight. It is called the carry trade, and it may be the single largest legal financial exploit in history. Here is how it works. Different countries have different interest rates. Japan, for most of the past 30 years, has had interest rates near zero. The United States has had rates significantly higher. This difference exists for legitimate economic reasons. Japan's economy has different characteristics than America's, but the difference creates a gap. If you can borrow money in Japan at near 0% interest, convert it to dollars, and invest it in American assets paying higher returns, you pocket the difference. The trade itself is legal. The currencies float freely. Anyone can do it. The gap is public knowledge. For 30 years, enormous quantities of borrowed Japanese yen flowed into global markets, chasing higher yields. At its peak, estimates suggested the carry trade involved over $1 trillion in borrowed yen. Hedge funds, banks, individual traders, everyone running the same basic exploit at different scales. The problem is identical to 1987. When the trade unwinds, it unwinds together. In August 2024, the Bank of Japan raised interest rates slightly, a small move by historical standards, the kind of thing that would normally pass without comment. Instead, global markets dropped sharply within days. The Nikkei fell 8% in a single session, its worst day since 1987. American stocks fell. Assets in South Korea, Taiwan, and Australia fell, all because a gap that had existed for 30 years suddenly became slightly less profitable, and the people running the trade all tried to exit at the same time. One small policy change. Trillions of dollars in simultaneous movement. A crash that nobody in mainstream media could quite explain because it required understanding a trade most people had never heard of. The exploit had become so large that it was now load-bearing. Markets had built themselves around its continued existence. When it wobbled, everything wobbled with it. This brings us to the deepest insight in this video. Legal financial exploits do not just make money, they reshape the systems they exist inside. The longer they run and the larger they grow, the more the surrounding system adapts to their presence. Other investors start pricing assets assuming the exploit will continue. Institutions build strategies that depend on the gap remaining open. Regulators write rules that inadvertently protect the exploit because the rules were written during the period when the exploit was considered normal. The exploit stops being a gap in the system. It becomes part of the system, and that is when it becomes most dangerous. Edward Thorp understood this. After card counting, he moved into quantitative finance and ran one of the most successful hedge funds in history for decades. He wrote later that the most important skill was not finding exploits. It was knowing when the exploit had become crowded, when too many people were running the same trade, because a crowded exploit does not slowly stop working. It fails catastrophically when it fails. The greatest financial exploit ever legal is not one specific trade. It is the recurring human behavior of finding a gap, profiting from it, expanding it, and then acting surprised when the gap closes violently. The rules allow it every time. The rules were written before anyone knew the gap existed. By the time the rules change, the next gap has already been found. Thorp walked out of that Las Vegas casino richer than he walked in. The casino changed its rules within a year. He had already moved on to the next game. The game never ends. Only the players change. Like and subscribe and turn on bell icon to get notification as soon as it is uploaded. We upload almost 2 videos weekly.